Hour.
And here is what I was double stuffing when I wasn't munching on 14 tons of Oreos and a giant glass of milk today. Check the internet, you'll figure out what I'm talking about. Number one, I read an interesting article on Bloomberg today about how there are tens of billions of dollars of additional credit crunch losses that the investment banks are filing with regulators, but haven't yet talked about on their investment conference calls. They're not telling investors about it. The credit crunch, guys, is about to get worse. Again, as Obi-Wan would say, you cannot escape your destiny. You must face Darth Vader again. Number two, take a look at the chart on the front page of the Wall Street Journal today showing the growth of the four major internet portal revenues. Google, it's grown 500% since 2004, while MSN and Yahoo haven't even stayed up with that company I was making fun of my drummer for still using as his email. You know, AOL. The stocks have performed similarly, of course, meaning, guys, think about this. Stock picking based on fundamentals matters. Stick with Google. Finally, let's put both of these first 2 points together to get point number three today. Back-to-back headlines on Bloomberg.com. Leading economic indicators index in U.S. unexpectedly rose 0.1% in April. And then this second one, auction rate collapse costs Google, UPS, JP Morgan shareholders $1.8 billion. Okay, guys, think about this. A rounding error growth in the economy is better than expected, enough to have a headline about it, just as the credit crisis spreads to corporate America's balance sheets. Meanwhile, the markets are indeed basically at all-time highs. This cycle has turned. You guys be cautious out there. You know you got to be cautious when we're in year 5 of an economic boom and things are getting worse.
Well, on that note, we're going to come to one of the hardest hitting questions